to our second quarter 2022 UOBAM Robo-Invest Portfolio Performance Update webinar. I'm Roger and I'm part of the UOBAM Robo-Invest team. For members of the audience today who are new, UOBAM Robo-Invest is Singapore's first robo-advisor in an e-wallet. Today, we have Mr. Dharmo Soejanto, Chief Investment Strategist, UOBAM Robo-Invest, to share with us how the portfolios have performed in second quarter and going forth, what is our outlook for the rest of the year. Before we start, here are some of the housekeeping guidelines. The chat box is available if you have any connectivity issues, and you can raise them in the Zoom host as well. There could be polls being shared across the screen for your selection, and results will be shared. Click onto the Q&A icon if you have any questions throughout the session. Click on any like button to upvote the questions raised, and also please scan the QR codes at the end of the webinar to access to the feedback form and download the page, or click onto the links available in the chat box as well. Also, please feel free to leave your questions in the Q&A section, and remember to sign up to UOBAM Robo-Invest today and get $10 credits. No top-up is needed for those who are new to us. And you could also receive a further $20 credits and 1,000 Dash rewards points when you top up $500 to your UOBAM Robo-Invest account. So let's look at today's agenda. Mr. Dharmo, we're actually going through the market commentary first before providing an update in terms of the quarter 2 performance. And after that, there will be he will round it off in terms of the market outlook and the strategy as well. Dharmo, please.
Thanks, Roger. Good morning, everyone. Glad to be here with every one of you. I hope you had a good morning. Let me start by running through what happened in the second quarter. I think if you have been watching your account, it would have been fairly painful. And I think if you've been reading the newspaper or watching business news, you would have known why. Basically, what we have seen is that the equities market has actually drawn down quite sharply. And that's partially because of a few things. One, of course, the geopolitical concerns in Russia and Ukraine. And that has sort of aggravated the inflationary environment that we saw around the world. I think if you've gone to the market or you've gone out to eat, you know that prices have gone up sharply recently, and that's a phenomenon that has been going around in the world. It's not just restricted to Singapore, but everywhere you see that sort of situation. Oil prices have gone up. We started the year at about $80, $90 oil, and then went up to 100 by first quarter. I think we hit 130, and I think recently it's sort of come down to about 100 level. So roughly speaking, oil price is now has gone up very sharply. You see it in your petrol bills, and that's basically with that sort of high inflation, central banks have been really forced to increase interest rates. Right, so in order to tame this inflation, the Fed actually had to hike rates, and I think the recent 2 rate hikes was 75 basis points, which is very, very aggressive. In the past, you know that their tendency is to move in 25 basis points or 1/4% step, but this last 2 moves, the US Federal Reserve actually hiked rates by 75 basis points at each meeting. So within 2 meetings is hike interest rate by 150 basis points. That's how serious the inflationary pressure is, that the US Federal Reserve have to be very aggressive in terms of increasing interest rates, right? That's basically trying to tame interest rate expectation. And when interest rate goes up, obviously it has a repercussion on the market as well as on the economy, right? On the economic front, basically, what we've seen in the US is things like housing market is starting to slow down because mortgage rate for them has gone up to about 5%, right? With interest rate going up, with Fed fund rate going up to 2.5% today, 30-year mortgage in the US have gone past 5%, right? So that has an impact on the housing market in the US, and also, of course, on things like your car loans, which basically dampens your auto market. But in terms of the financial market, it also has an impact, right? Think of it in the sense that if you think that a stock, the stock price is basically a discount of future earnings flow or future cash flow, then when the interest rate goes up and the discount rate goes up, then by definition, your future earnings is worth less, and therefore the stock price will go down. And that's what we saw in the market in the second quarter. And the biggest impact are those what we deem as growth stock, meaning that companies that are growing, so a big part of their value is really far out in the future, right? For those companies, because of the higher discount rate, that future value of their future value comes down drastically more than some companies in which that most of their value is derived in the more foreseeable future, right? If most of my earnings is within the next 2-3 years, an increase in discount rate affects it less than if the value of the company or most of my earnings is derived, say, 10 years out, right? So if my earnings is derived 10 years out, the stock price will be affected more by this increase in interest rate, right? Which is why we see a very broad-based sell-off in growth stocks, like even including Apple and Microsoft. So initially it was your Facebook, your Google, or a lot of the unicorns in which that they are not making money today, and basically their value is supposedly far out in the future when they make a lot of money. For those companies, the impact of this increased interest rate is really much sharper, right? I think in Asia, what we saw was that we actually performed slightly better. Okay, one is, of course, we have less inflationary pressure in this part of the world. Let me give you a comparison. In the US, last month, for the month of June, inflation was running at 9.1%, right? In some of the bigger countries in Asia, I think the inflation rate is running at about 2 to 3%. So our inflationary problem is less severe, which basically means our central banks have less needs to be as aggressive as the Fed in terms of hiking interest rates. We would still move in the same direction in terms of interest rate increases, but we don't need to be as aggressive, right? And because of that, Asian equity market actually has outperformed. In fact, the best performing market in the world this year is probably Indonesia, or at least one of the best performing market this year is Indonesia. Right, and in China, there was also after the sort of sharp sell-off since last year, there is actually now an increased expectation or increased hope that the Chinese government would now start to ease, and which they have. They basically in China, they have actually cut interest rates, and they basically started to sort of be less stringent on the internet sector as compared to what we saw last year. However, the more recent development obviously was that there was COVID lockdown in China that has affected the economy and sentiment a bit. And recently what we have heard is, of course, The housing market is going through a rough patch. Home buyers are basically are striking in terms of paying their mortgages, and that is causing a bit of uncertainty in China. And so that's why I think in recent weeks, we see a sell-off in China again. But if we look at just at the second quarter, actually China did relatively well, Asia did relatively well, and the performance is actually quite stark in the sense that the global market was down 13.4%, but Asia is actually down only 6.7%. So that's almost a 7 percentage points outperformance. It's still down, but at least the drop wasn't as painful as if you have held on to global markets, right? So that's basically on the equity side, the inflation, the geopolitical uncertainty, as a result, the increased interest rate had a very sharp impact on equities market, right? If I may go on to the next slide, what we saw was that bond market was actually not spared, right? Because as interest rate goes up, bond prices comes down. That's basically the basic of bond mathematics. The reason is this: if your bond pays 2% coupon, and now market interest goes up to 3%, the bond prices have to come down to reflect that, so that your 2% coupon becomes, say, a 3% yield, right? So it would have your bond prices will come off by a bit. How much that comes off depends on how long that bond duration is. The longer the bond duration, the bigger the impact on the impact on the bond price, right? So as a result of this, basically what we saw, remember that US bond yield rose very, very sharply. At the beginning of the year, it's probably only about 1.5%. At its peak in mid-June, the US 10-year yield actually went up to 3.5%. That 2 percentage point move, if you have held a 10-year bond, would roughly translate to about, call it 16, 17% capital loss or mark-to-market loss, right? And that can really be very, very painful. So that's why if we look at the sort of the bond index, the Asian bond was actually down by about 1.3%. Global bond is actually down by about 4.3%, right? But the high yield, that's really the non-investment grade, is the one that's taken the highest hit. The biggest hit is down 7.3%. And part of this was because during this period of time, there were concerns about Chinese property developers defaulting on their bonds, right? They are having problem repaying their debts and repaying their bonds, and therefore a lot of Chinese developers' bonds were sold off very sharply. And Chinese developers actually make up a fairly significant portion of the high yield bond market in Asia. So that piece actually was down 7.3%. But the situation is that even had you held on to the safest US Treasury, say a basket of US Treasury or the US Treasury index, for the year, I think you would still have been down about 7 to 8%. And this is supposedly one of the safest asset class that you can hold, right? US Treasury. This is a US government bond that will almost never default. And you would still have a mark-to-market loss of 7 to 8%. And that tells you this year has really been an unusual year. There is almost no place to hide. Have you bought bonds? You have lost money. You bought equities. You have lost money. There's really very little place you can hide, in the sense that as long as you invest, most likely than not, you have lost some money here. Right, so that's basically the current situation. What we saw, as I mentioned, in the second quarter, equities were down, roughly speaking, anywhere roughly double digit for a global equity portfolio. And for a global bond portfolio, you have been down about 4%. That's a difficult market to really to navigate. Okay, and how that impacted the portfolio? If we go to the next slide, basically on the very conservative portfolio, roughly speaking, we would have lost about 3%. So I told you that in the global equities was down about double digit, global bonds were down about 4%. But for the most conservative portfolio, we've actually managed to contain that loss to about 3%. And that the reason is, of course, for this, we tried to be very conservative, and a big chunk of this portfolio is money market fund. And money market fund generally has don't lose money, right? You make very little money, but you don't lose money in this sort of volatile market. And even in our Asian bond portfolio, that Asian bond was actually doing relatively well because it is invested via our SGD fund. And our SGD fund holds very short duration investment credit bonds. And I think if you have seen the if you've seen the number just now, Asian bond was down, roughly speaking, about 1.3%. So these two pieces have held relatively well. So 70% of the portfolio have held relatively well. The drawdown really is on the US equity, which are down about low teens, which basically contributed the bulk of this 3 to 3.5% negative return, right? If I may go on to the next portfolio, this portfolio is probably hit a bit harder, as I said, because it has a higher risk tolerance. So we actually don't hold money market fund in this portfolio. There is still the Asian bond, which still accounts for that 40%. But 30% of this portfolio is in US equity, which was down in the teens. But 18% is really in Singapore government bond. But as I mentioned, even government bonds lost a bit of money this quarter. Right? I think the Singapore government bond lost in about 3 to 4% range. And then we have the Asian ex-Japan equity, which was down about roughly 6%. The net impact is that this portfolio ended up being down about 5.5 to 6%. It was meant to be able to take a little higher risk for higher return. Therefore, there was probably a bit less. There are less risk-free assets in here. A little bit more equity and risk-taking inside here. So roughly speaking, this is about 60% in low-risk assets, in bonds, and 40% in equities, right? This is sort of the kind of return that we've managed to control. And if I go to the more moderate portfolio, basically this one is even more slightly more aggressive. There is 40%. There's still 40% in Asian bond, but there's no Sing government bonds in here. It's largely in US equities and Asian ex-Japan equities, which now makes up about 60% of the portfolio. Right. So the Asia ex-Japan equity, the US equity is roughly about the same at 38%, but instead of Sing government bonds is now in Asia ex-Japan equity, and that has sort of probably slightly higher losses than the Sing government bond. That's why you see about an extra % of losses in this portfolio versus the conservative portfolio, right? So, but imagine that on a 60% equity portfolio, if we have, that would have, roughly speaking, would have lost about 6 to 7% in losses. So basically, as I mentioned, we've sort of controlled the losses to a relatively tight range or manageable range. If I may go on to the more aggressive portfolios, the aggressive portfolio, again, as we mentioned, this is now higher, supposed to be able to tolerate higher risk. 40% of it is in US equities, 36% in Asia ex-Japan equities, and 5% in global equities, 3% in US REITs, right? So basically, if you think of it, the sort of lower risk assets is now, roughly speaking, only about 17%. If you include the cash, it's probably about 17, 18% in low risk assets, and almost 80% in 80% in equities position. And that basically resulted in about 9% in portfolio loss as a result for this quarter, right? And the very aggressive portfolio is effectively 100% equities. There is no bonds inside here. There's a thin sliver of cash, and that return is about 10 to 11% in terms of drawdown. As I mentioned, that 10% is the sort of the balance between the global equity portfolio which drew down about 14%, and the Asian equity which drew down, roughly speaking, about 7%. So if you sort of find that balance, you're talking about roughly about 10% return, right? So minus 10% return. So that's what the portfolio has delivered. And in fact, if you look at it, the global portion of the global equity portion is roughly 60%. The Asian equity portion is about 40%. So yeah, I would say that the maths work out to be right. You're talking about 10% of drawdown here. Right, so basically that is how the portfolio has performed. I mean, basically it has performed in line with the market, but we've controlled the losses on the very conservative portfolio because the Asian bond has a very short duration, and there was a significant allocation to money market fund, which basically means that the losses were actually very controlled, right? So what do we see from here going forward? Okay, so basically, we think that inflation would linger. The latest inflation number from the US just came out last night. And that number is 8.5%. Okay, it's actually still very high, but market rejoiced that it came down from 9.1% in June that I was mentioning, right? 9.1 was the highest inflation the US have seen in almost 4 decades, right? And so they have not seen such high inflation for more than 40 years. So coming off from 9.1% to 8.5% is a big step, but 8.5% is actually still very uncomfortably high. Imagine that if I tell you like this month, our inflation is 8%. I mean, we will probably freak out, right? So the month-on-month number is actually about 0.5%, but the sort of the year-on-year number is about 8.5%. So I think we think that number would slowly come down, but it would probably be until next year before we see about the sort of 3 to 4% level that we are probably more comfortable with, right? The core inflation, meaning that excluding food and excluding energy, meaning oil prices, the number was about 5.9%. As I said, again, it is sort of has come off from the 6.5% we saw in March, but it is still uncomfortably high. And the Fed has basically reiterated that they would continue to raise interest rates in order to bring this inflation level down. I think in all along, Fed has an inflation target of 2%, and trying to bring that 5.9% down to 2% would require the Fed to continue to raise interest rates going forward until we see sort of a 3 to 4 handle, right? And basically, that's the current situation. What we've seen on the inflation front is that goods inflation are starting to come off, meaning, like, for example, used car prices that was a significant contribution to inflation is starting to come off. And even oil prices have started to come off, right? It used to be about 130 at its peak. Now it's actually below 100, right? In the US oil price, what they call the WTI, is now below 90, right? So that's the kind of situation that we are seeing because of the expected slowdown in the economy. Some of these commodities prices, raw material prices, are starting to come off, and also partially because as sort of supply chain comes back online, we are seeing sort of a bit of easing in terms of supply bottlenecks, and that's also increased the supply and sort of has an impact of lowering prices. So with that, we think that goods inflation will gradually ease off. But what we are seeing is that service inflation is starting to pick up, especially given that there is labor shortage. I think we've seen that especially in the US and in Europe, but also in around us in Singapore, we're talking about labor shortages. Because of that, we are actually seeing wage inflation. And with wage inflation, that often gets translated into your goods and services prices, especially services prices, because service is usually delivered by people, and if there's wage growth, then service prices will go up. So we are in this position in which that goods prices are coming down, but service prices is going up. So goods inflation coming down, service inflation is going up. It is this tug of war, and we are counting on the fact that given that there will be slowdown, there will be energy prices coming off, and as supply chain gets normalized, this would basically pull inflation down to a more comfortable level. And of course, as we mentioned, with higher interest rates, economy does cool off, and that would usually means lower prices. However, what we expect is what we call a soft landing, meaning that we expect a slowing growth without a significant recession. I think the concern market had in first and second quarter was that the aggressive rate hike would basically push the US economy and the European economy into a recession. Okay, what we think is that this recession is engineered by the central bank, or the central bank is trying to engineer a slowdown in economic activities without causing too much hardship in terms of job losses and unemployment. And what we see is this current situation is not about the economy being in an overheated situation. What do I mean by that? Usually when economy in an overheated situation, it means that you are already producing at peak level. You are producing at at the maximum capacity that you can produce, right? And because you're producing at a maximum capacity that you are producing and you cannot meet demand, therefore you raise prices. That is inflation when economy is overheated. Today, we are not there, right? So basically think of it, we basically look at numbers like car sales. In the US, in a normal year, the US would probably be doing 17 million units of sales in terms of cars, right? Today, the number is about 13 million annualized. So there's a 4 million gap. So it's not because we are producing too many cars. We are actually still not producing enough cars. But the reason why car prices were going up in the US was because of the supply bottlenecks, right? There was shortage of chips, and therefore, because of a shortage of chips, they could not produce enough cars. Because they could not produce enough cars, car prices went up. So this interest rate hike is done in a period in which that the economy still has a lot of spare capacity. It is not trying to tame the demand because we don't have spare capacity. It's because we're trying to tame the demand because supply could not catch up, right? So this sort of rate hikes, or this sort of recession in that sense, or this sort of slowdown, should be relatively mild, because it is not about overheated economy, too much inventory in the system. Is that we don't have enough inventory in the system, right? We have not produced enough to satisfy everyone. So this sort of economic condition usually means that as when the supply comes back, or when supply starts ramping up, we can actually increase the supply, and therefore and cut and reduce prices, and therefore inflation comes down, right? So it's that kind of relatively benign economic condition that even if there is a slowdown, it should be relatively mild and gentle. And today, if you look in the US, basically employment is still very, very strong. People are still trying to hire. No one is cutting people. I mean, there are going to be some segments that you hear about job cuts and everything, but as a whole, the economy is still hiring. And basically, that's what the Fed is trying to do, in a sense that they're not trying to impact the job markets, but they are trying to cut down on job openings, meaning that try to temper people's business demand for workers. But by the look of it, the hiring is still ongoing, and the sort of labor market is still very, very healthy and robust. That's why we think that the soft landing scenario is probably the most likely situation, in the sense that people still have jobs, people are still making income, and therefore we will not see a very sharp pullback in terms of consumption that what we typically see in a recession. Right, so that's what we think in terms of our outlook for the US economy and for the global economy. However, inflation is probably still the most important variable. As I mentioned, we think that inflation probably come off from here, given the fact that the sort of energy prices starting to come off, and certain sectors are starting to cool down. We think goods inflation is definitely coming off. What we are watching out for is now for service inflation, and that's why we're staring at inflation very, very closely. We are hoping that core inflation will start to come off as well. What we've seen is that it sort of plateaued after coming down from 6.5%. It sort of plateaued here. We hope that it will continue to come down from Whereas on the good side, definitely we've seen that one step down, but again, one swallow does not make a summer. We need to watch what happens in the next few months. And so far, the idea is that central banks are still very diligent and basically they're still very watchful, and they're basically saying that we still need to continue hike interest rates in order to bring that level down from the 5.8 or 5.9 to at least sort of three handles, right? So rate hikes will continue, but what market is taking comfort is the fact that the central banks have built up credibility, right? Since about mid-June, what we see was that 10-year interest rate starts coming down. That's basically the bond market or the financial market saying that, hey, Fed, we believe in you. We believe that you are going to going to do what you say. You are going to bring inflation down, and you are able to bring inflation down. That's why sort of the 10-year yield started coming down from 3.5% to about 2.8% today, right? So it is a credibility or central bank credibility issue, and the financial market is basically giving credit to the central banks and saying, hey, we believe that you will be able to bring inflation under control. The short-term interest rate, the 2-year rates have continued to go up simply because the 2-year rates reflect what they believe the Federal Reserve is going to do, meaning that they'll continue to hike rates. So the 2-year interest rate is now about 3.2%, which is higher than the 10-year rate. So which is what we call an inverted yield curve, right? You have a lower 10-year yield compared to a 2-year yield. So that's basically the situation. Inflation is important. What central bank does is important. But so far, financial market seems to suggest that they believe that the central banks would be able to bring inflation down. They have earned their credibility, and financial market therefore can behave normally from here, right? In the first 2 quarters, there were concern that inflation is running out of control, that the central banks are behind the curve, are actually behind the curve in terms of controlling inflation. Today, what the financial market is saying is that we believe the central banks now is doing its job, are doing their jobs, and they will be able to bring inflation down. Therefore, financial market can behave more rationally and normally. Bond market is now probably a bit more stable. And equity market has also sort of taken a bit of comfort. What we saw was that in the last few weeks, there's a rebound in the US market. And the reason is, of course, one, interest rate has come off, and therefore sort of the discount rate has come off, but also because the stock market really hates uncertainty. And if the uncertainty is really about what is the right discount rate, that makes for volatile stock market, because you have to keep on guessing what is the right interest rate to use for your valuation, right? Whereas if now the sort of bond market is more stable, or rates market is more stable, then at least there's less uncertainty. You know, roughly speaking, what sort of interest rate to use to value the stocks, right? So that's why when there's lower uncertainty in the rates market, equity market can also perform. And as we mentioned, right, this was actually prepared end June, early July. Today we are in early August. We were saying even back then that there were investment opportunities forming, and we are investing cautiously in a very uncertain environment. What we are saying is this, right? After the sell-off in the first 2 quarters, a lot of things actually started looking cheap. Imagine that last year, when we were planning for the launch of the Robo, the expectation for government bonds in terms of returns, or the return expectation was for government bonds, was about 1.7%. I remember it was sort of very, very sort of mid 1% level. Okay, can you imagine that we were expecting, if you hold a 10-year bond, a bond for 10 years, you're going to get call it 1.5% every year. Today, that number is actually up to almost 3%, right? You expect that if you buy bond, you get about 3% return. That is a very sharp jump. And you're talking about the return almost doubling, right? Again, last year, given the strong equity market, we were saying that equity market return for the next 5 years is probably more like 5%. The most recent numbers that we use in terms of the Robo is that we expect 7%, 7+% return on equity markets, because you have the market has corrected 20%, right? So if you think of it, that makes equity market cheap. And if you sort of just account that 20% over the next 10 years, you get, roughly speaking, about 2% extra pickup in terms of expected return, right? So that's the situation that we are in. And that's why we actually said that we think that there are investment opportunities forming, and we think that we need to invest cautiously. The reason why we say cautiously is because market volatility has gone up, right? Remember that last year or previous years, we are in a very low volatility market. Market was very, very stable, and there were very little volatility. That allows us to really lean into sort of the riskier assets, meaning lean into equities, because market volatility is really low. However, with this current situation, given that market volatility high, equity volatility high, in order for us to continue to maintain the portfolio at their various risk level, meaning that if you are very conservative, we know that you cannot take too much volatility. So each risk profile has a certain, what we call a volatility target. I mean, that's a very technical term, but basically we say that it cannot deviate by too much from a certain risk level, right? So because the every asset class, the volatility has picked up, that would mean that for going forward, for most portfolio, even if you're talking about the same risk profile, you typically would have a little bit more low risk assets, meaning a little bit more bonds, and a little less equities, or a little less risk assets. That exception is probably in the very aggressive portfolio. There's probably still going to be 100% equities, but otherwise, if we look across the sort of various risk profiles, don't be surprised that we would probably allocate a little bit more bonds and a little less equities for you, right? And as we mentioned, we are continuing to closely monitor the situation, but we believe in remaining invested through the market jitteriness. It's just that the positioning would probably change slightly as we go forward, given the market volatility. Okay, and there are also certain things that we are still concerned about. I mean, we talk about inflation, that it will take a while for it to come off. But what we are seeing is, of course, financial market seems to have moved from being very depressive in June to actually fairly buoyant today, right? Yesterday, we saw the NASDAQ was up 3%, S&P was up 2%, simply because inflation is 8.5%. if you think of it as a standalone basis, 8.5% is still very high inflation level. Why should the market be so buoyant? But it is what it is. So there is some buoyancy on and some exuberance and probably a bit complacency in the market, and that's why we are a bit mindful of that as well. And we are watching the markets and very carefully and try to formulate a proper investment strategy for you. Right, that brings me to the end of my presentation. Back to you, Roger.
Hey Damo, thanks so much for the insights in terms of the portfolio's performance, the review, and then going forth, what is our outlook as well for second half as well. There are a couple of questions within the Q&A session segment itself that is asking quite a fair bit in terms of the asset allocation, the rebalancing, and the ideas and all that. So, probably do you want to share with us in terms of the overall concept in terms of when it comes to the key notable changes to the portfolios? That's one. Number two, what is the thinking in terms of the CMA changes when it comes to the Robo-Invest portfolios? I'll probably let you start off with that before I come in terms of trying to remind everybody here again, especially those that are new, that what the Robo-Invest portfolio is all about, because I think you mentioned about the vol target and all that, and what is the overall the gist of it and how different we are as well. So maybe Damo, you go ahead first in terms of the concept of the changes and the allocation as well.
Sure. As I mentioned just now, because of the increased volatility in the market, what we are doing is that basically we would have moved, in general, we would have moved your portfolio to a little less risky assets. So basically, we'll probably have allocated a little bit more bonds and a little less equity to your portfolio. As I mentioned, the exceptions are probably on the very aggressive side, which probably still holds mostly equities. But even then, we would have probably sort of shifted from the more volatile equities to the less volatile equities. We will probably have moved from Asian equities to more broad-based global equities, or we would have moved from, say, US growth stocks to probably something more broad-based like global equities. So it's that sort of, in principle, is that sort of shift, meaning that because of the higher volatility in the market, we are probably shifting most of your portfolio to a less volatile asset class.
Okay, thanks, Damo. Probably I'll just answer one of the questions in terms of, I think there was one question saying that timing of reducing risk looks a bit off right now, given the rally yesterday. I just want to add on for the members of the audience today, especially those who are new to Robo-Invest, is that the portfolios has been structured from a volatility standpoint, meaning to say that there's the investment team, Damo and team, right? They actually set a volatility target for all the portfolios itself. And the portfolios are structured from a capital market assumptions, CMA kind of a standpoint. So basically every risk, or rather every asset class itself, right, they will have a prediction to say that probably let's say US equities, what kind of expected returns we are looking at. That's where the investment team will set all these parameters for all the different asset classes and then put it into an optimizer. So the optimizer will then optimize the best allocation based on what is the vol target that's being set. So assuming, let's say right now that the investment team thinks that US equities for the next 3 to 4 years, we are expected return 6% per annum, and for aggressive portfolio, probably the vol target is 7%. So that's how the optimizer would actually optimize the best allocation towards the US equities, given how much the volatility target is being set at, which is 7%. So it doesn't mean that right now it looks a little bit off because the rally is happening, but we need to think that from a robo standpoint, right? It's not meant to be a by the way, or it's not meant to be an overnight kind of a success rally, what individual stocks or what individual ETF could produce. We need to think from the angle whereby you probably have a little bit of a considerable time horizon you're looking at, and the definition of that probably you're looking at 3 to 5 years at least, and even for longer term as well. So we might think that, or rather you might think that right now it may not be the best time to take off some risk given the rally, but from the investment standpoint, we need to think what is the long-term expected return of that particular asset class, given the vol target of the portfolio. So hence that is the difference why is a little bit different when you buy into a robo versus you buy into a single stock, you buy into a single ETF, and that's how the portfolio is being constructed. So probably I just wanted to add on a little bit on this part, and probably Dharmo, you want to add on a little bit more on this as well?
Yeah, I see the question in terms of why are we reducing risk and why did we reduce allocation to Asia ex Japan and add it to global equities? It's precisely because of that, right? Because of the higher volatility, the nature of the robo is such that when it's volatile, when market is volatile, we need to reduce your portfolio risk in order to meet the sort of what we call the vol target, or the risk profile that you are that you have said that you are in. So in this rebalancing, the general trend is that we would have reduced everyone's risk because market is now more volatile. Right? We will have reduced everyone's risk, and for part of that process is if we look at sort of historically, Asia ex Japan typically is more volatile than global equities. Right? A single market, a single region is always more volatile than a global. A single market usually is more volatile than say a global portfolio as well. So that's why we sort of reduced allocation to Asia ex Japan and added more to global equities, precisely because we are trying to reduce the portfolio volatility for everyone. Right, so that's generally how we look at it. And again, we don't look at one quarter, right? As we mentioned, last quarter, Asia ex Japan did better than global equities. And we might get question is, why don't you put 100% in Asia ex Japan equities? That would be better. The portfolio is meant to be diversified. It's meant to be diversified across asset class, across region, so that we don't put all the eggs in one basket. Because obviously, focusing in one region could increase the risk of, especially when something goes wrong, right? Today, you look at it and it says China, there are a lot of concerns that problems are brewing in China. And in fact, for the month of July, actually Asia underperformed the rest of the world. So it's going, we don't try to take a 1 quarter or 1 month view. And we basically work off a sort of long-term expected return and risk expectation for each asset class, right? And therefore, we basically try to provide a diversified and balanced portfolio for you, so that you are not exposed to any single region or single country risk.
Thanks, Dharmo, for adding on. Probably I will just answer one of this question in terms of I think you're sharing of the capital market assumption to be shared across the CMAs. Unfortunately, this CMA is actually a proprietary tool or the analysis coming from the investment team at UOBAM itself. But having said that, I mean, I do get the anxiety or probably the question marks from clients to say that, hey, so what is it all about? Probably I'll just later on we can share in terms of the links in the chat box as well, where we have published in terms of our quarterly investment outlook, our for this quarter, third Q, and also for fourth Q as well. From there, right, you can actually have a gist of where are we seeing in terms of the overall macro outlook from a fixed income view to the equity view, even the currency view, and also some of the alternatives view as well. So that would actually forms the bedrock, I think, as an investment house across board, regardless whether you are buying to Robo or whether you are buying to our direct funds that's under UOBAM itself. So that sets the tone of the whole investment team. And Dharmo himself is also in the teams as well. So from that angle itself, that actually will kind of constitute to, it will cascade down further into the CMAs itself. And hence, it may not be the true reflection and 100% representation of what the CMAs actually were. But unfortunately, that is proprietary. We are unable to share. But what I'm trying to say is that, we do publish our overall macro view from time to time, especially every quarter itself, and also every year as well. So that will actually give you a little bit of the gist and the flavor in terms of where we are looking at from a house view itself. And that will set the tone. in terms of how the CMAs will be probably projected, given some of the history they're looking at, and also and given some of the I wouldn't say black swan events, but some of the unexpected events that actually happen. So the CMAs itself is not 100% theory and all that. There's a little bit of the elements whereby the investment team will look at it and consider before coming up with the finalized CMAs itself. And there is a team that actually looks at it before the approval is given as well. So that I just wanted to add on a little bit on that. And Damo, you want to add on a little bit on that part as well?
Basically, the CMA committee is made of 5 people, and we say that there's probably like almost 200 years of investment experience among the 5 of us. Well, no, probably it's more like 150 years of investment experience. It's made out of the CIO, the deputy CIO, myself, our head of multi-asset strategy, and our head of portfolio solutions. So basically, the 5 of us basically stare at this CMA, and there's usually very robust debate in terms of whether we think that the CMA is right or wrong. And then at the end of the day, we sort of finalize it, and then after that, we send it across the region and get endorsement from the regional CIOs as well. But basically, I think that's basically, we don't plug this off the air. As Roger said, we basically base it on historical numbers, on historical trends, on valuations, on where we think the asset class is versus its own history, and to a certain extent on the market conditions. So basically, sometimes we tweak the CMA, whether we think that it should have lower return because of certain factors, or it should have higher volatility because of certain factors. That's how we sort of implement our investment views into the CMAs.
Yep, thanks, Damo, for adding on to that. Maybe just one question, I guess. I think they were asking in terms of, is there a timeline and a fixed period whereby the volatility and risks will be adjusted? I think Damo have answered that, and then they look ahead. But do you want to add on a little bit just to provide a little bit of a timeline so that clients that are here today, and also those that are new, they probably have some some reference point in mind to say that, okay, when I'm buying into this portfolio, how should I be looking at from a timeline perspective, and then what kind of risk am I being expected to as well?
We look at the CMA on a quarterly basis, right? So basically, we review the CMA on a quarterly basis, and then once we have that, we model what the portfolio should look like based on the CMA that we produce, right? And then whether we rebalance depends on whether the existing portfolio or the proposed portfolio is very different from the existing portfolio. If it's minor difference, if it's only minor changes, we actually don't rebalance, because we are trying to reduce or minimize trading costs and sort of the trading friction. So if there's very little change in the portfolio as a result of our CMA review, we actually don't implement it. So you don't hear about your rebalancing, and you don't hear about changes to your portfolio. But if there is significant changes, then what we do is that we'll implement that rebalance in the portfolio, and you'll get notification on that we've actually conducted a rebalance and what we have done to your portfolio, right? So that's basically how the process works. So the short answer is that we look at the CMA on a quarterly basis, and then we decide whether we rebalance this or not.
Okay, thanks, Damo. Okay, so for the members of the audience today, unfortunately, in the interest of time, we will end today's presentation here. I just want to share and with the people here today is that for those who are new, like I said, we do have an ongoing promotion right now. So from now until the end of this month itself, you do get $10 free credits when you sign up. There's no top up required at all, and you do get an additional $20 credits plus 1,000 dash rewards points when you top up $500 into the UOBAM Robo-Invest account. For all other questions, right, please feel free to reach out to us. We'll provide the contact details as well. And lastly, do help to fill up the feedback form to us, and also we'll take in the feedback seriously as well, and then we will keep in touch as well. So that's all for us today, and thank you, and have a pleasant day ahead.
Thanks, everyone.